Hey guys, so Dan from Trading with Dan here. So today we're going to do something a bit different. We're going to talk about a real life superhero here, a real life superhero of the financial markets. So here I'd like to introduce to you all Helicopter Ben. So I don't know if any of you guys have heard or know about Helicopter Ben, but this is Ben Bernanke. He was the Federal Reserve Bank chairman, basically the one before Janet Yellen. So he is the guy that was responsible for basically helicopter money and for the first QEs. So this guy basically is the guy that backed the Fed into the corner that it is now. And there are rumours that a lot of Fed people they just can't stand this guy for basically what he did to the Fed, and the corner he basically backed them in with his QE and yeah, just going down that whole line. So what he is famous for as well, especially amongst like gold bugs and gold circles. Not that I'm a gold bug, but the speech is of note for other reasons. But yeah, what he's famous for was his famous helicopter speech that he did. So this is the speech here. Remarks by Governor Ben Bernanke before the National Economists Club, Washington DC, November the 21st, 2002. And the speech was titled "Deflation. Make sure it doesn't happen here." So I'll go through some of this speech with you guys in quite a bit of detail, and I will verbally annotate it as well. But the main thing that I want to go down to, just to basically give you guys the main gist of how the central bankers think, and how they think they can not ever have deflation, because we are at risk. Basically, deflation of asset prices, and obviously the destruction of capital that will occur when that happens is basically what's underway in the market at the moment. There is a massive destruction of capital as asset prices are going down. Some of them are basically free fall. There isn't the actual cash for people to buy them, so there's no bids, so these things are going straight down, and that is basically deflation. That's a deflationary impact. So that's why the Fed is pumping in various different ways, in various different programs, and various different schemes that it has, is pumping quite literally trillions into the market to basically try and plug this gap, and to try and calm the financial system ship, try and steady the boat, and try and ultimately their aim is to keep driving prices back up again. But that is definitely going to be easier said than done. So I'm going to go through this speech, and it'll take a while to go through it. But I'm going to go to the main bit, and read that to you guys first. So obviously anyone that's not too interested in the details of the speech and deflation and the central bank policy don't have to necessarily listen to the rest of it. So regardless of how we get to the deflation, obviously I've told you guys we've got this capital destruction. I mean, inflation, from an Austrian school economist view, is quite literally the increasing of basically the currency in the system. So the increasing of that fiat currency, and that is inflation. And then that increasing the amount of that currency can then percolate its way through to higher prices of various assets, and that's probably the more common definition for inflation that people know, and that's the price of an asset going up. But very simply, that asset price will go up because there is an increase in the overall amount of currency. So conversely, deflation is a decrease in the basically amount of currency or reserves in the system, and quite obviously deflating asset prices, which is obviously the opposite of increasing asset prices, causes a destruction of capital, and then causes a deflation in that currency base. So curing deflation. So this is the part of the speech. We'll talk about deflation, what deflation is, how it's going to get tackled, things they can do. But here's the main thing that we want to talk about, so we know how these guys think. Right, so let me start with some general observations about monetary policy at the zero bound. Sweeping under the rug for the moment some technical and operational issues. So what he's talking about is, so assume we've got to the zero bound, to interest rates of zero, which we have now as of couple of days ago, as of Sunday evening. We're now at the zero bound, and then what he means by sweeping under the rug the technical operations is obviously how the Fed can maintain that zero bound level of the interest rate of the federal funds rate. As I've mentioned, some observers have concluded that when the central bank's policy for rate falls to zero, its practical minimum, monetary policy loses its ability to further stimulate aggregate demand and the economy. So another aspect of earlier in this speech, if you read the whole speech, they basically think that the only thing that causes deflation is a reduction in aggregate demand, so a reduction in people spending and consuming, etc. But there are clearly other deflationary impacts, such as cheaper labour in other countries. So you sort of import that deflationary wage bill. There is the technological advancements. So you can basically create better things for less money, and that is a deflationary force. But anyway, they like to concentrate solely on aggregate demand. So at a broad conceptual level, and in my view, in practice as well, this conclusion is clearly mistaken. Indeed, under a fiat, that is paper, monetary system, a government, in practice, the central bank in cooperation with other agencies, so basically with the say-so of other government agencies such as the Treasury, should always be able to generate increased nominal spending and inflation, even when the short-term nominal interest rate is at zero. Right, so now then he goes to explain with a little anecdotal example of how to do it, that ironically he uses gold as the example. So that's sort of why the gold bugs like to like to talk about this, because obviously he's using gold as the example. He could have used anything, but he used gold. So the conclusion that deflation is always reversible under a fiat money system follows from this basic economic reasoning. A little parable may prove useful. Today, an ounce of gold sells for $300, more or less. This is in 2002. Price of gold is $300. So now suppose that a modern alchemist solves his subject's oldest problem of finding a way to produce unlimited amounts of new gold at essentially no cost. Moreover, when his invention is widely publicized and scientifically verified, and he announces his intention to begin massive money production of gold within days. So what would happen to the price of gold? Presumably, this potentially unlimited supply of cheap gold would cause the market price of gold to plummet. Indeed, if the market for gold is to any degree efficient, the price of gold would collapse immediately after the announcement of the invention, before the alchemist had produced and marketed a single ounce of the yellow metal. So there are some subliminal messages that I see that when they write things like this, and one of the things is that the Federal Reserve isn't necessarily in control of money in the system. That is the banks and the primary dealers. All the Federal Reserve can do is give these guys cheap or free money, the primary dealers, and hope that they then buy an asset or loan it out into the real economy. So basically, and the Federal Reserve, and then also interest rates that the Federal Reserve sets, that doesn't necessarily mean that banks are then going to lend to each other or anyone else at those interest rates. So a lot of what the Fed does, well, when I say a lot, I mean basically all the Fed does is just manage sort of expectations by just saying things without the actual mechanism to actually do it. So it's interesting that they say that gold would collapse immediately after the announcement of the invention, before the alchemists had even produced or marketed a single ounce of the yellow metal. So what it's saying is just the knowledge that they have said something or has something, this alchemist, that will then reduce the price of gold. So that's sort of like what the Fed likes to do without actually being able to, without actually doing anything, because they can't actually do anything, can't physically do anything. They try and manage things by basically sort of having like a threat that they could do something, but basically they can't, otherwise we wouldn't be in the problem that we're in. So what has this got to do with monetary policy? So like gold, US dollars have a value only to the extent they are strictly limited in supply. But the US government has a technology, they call this a technology, like the alchemists invented some amazing technology to produce gold. The US government also has some amazing technology to basically produce the equivalent of gold, and it's called the printing press. Or today, even better, it's the electronic equivalent. So they have a keyboard that somebody can take his finger, press the buttons, create a digit on a screen, and then create the money. So isn't that excellent that I have such a fantastic machine? I mean, where has this been all of human evolution? So anyway, that allows it to produce as many US dollars as it wishes at essentially no cost. By increasing the number of US dollars in circulation, and again they say this again, or even by credibly threatening to do so, whereas I don't know whether it's credible, but the market thinks it's credible because it actually can't increase the number of US dollars in the system, because it can't force the primary dealers to make loans or purchase an asset. But the market says even by it says here, even by credibly threatening to do so, the US government can also reduce the value of the dollar in terms of goods and services, which is equivalent to raising prices in those dollars for the goods and services. We conclude that under a paper money system, a determined government can always generate higher spending and hence positive inflation. So what it is basically saying is that they can increase the price of goods and services by basically debasing the value of the currency, which then generates, in inverted commas, higher spending, because you have to spend more to then buy those same goods or services because the underlying value of the currency is lower. So if you can understand that concept, what they are saying is that we can just debase the currency, and that will basically result in inflation. But it doesn't result in inflation. It results in inflation of the money supply, but then that money then is worth less. So it's a fool's errand, isn't it? And all it really does is sort of mask insolvencies and just inflates away debt. So it's pretty ridiculous, really, that these are the guys that are in control of the monetary system. And then don't even get me started in Europe. Europe have been buying everything, all corporate bonds, and had negative interest rates. So they've gone off the plantation, basically. So right, I was actually going to read through the whole of this speech for you guys, but I don't actually think that might be that productive for you guys, because it may just be worth you guys having a read through it yourself if you are interested in it. It is very good. It's very good for understanding deflation and understanding how central bankers view deflation and what they think they can do about it. What I will actually read is the last bit here about Japan, because it's all well and good them saying that it will be so easy for us to not have deflation because etc blah de blah, because we can just do this, what I've just explained to you guys. So then how come Japan has been stuck in a deflationary, what was initially a lost decade, so now that's basically a lost 3 decades, when it's just so easy to get rid of deflation. So right, so let's just read this quick because it's not very long anyway. So the claim that deflation can be ended by sufficiently strong action has no doubt led you to wonder, well, if that's the case, why has Japan not ended its deflation? The Japanese situation is a complex one that I cannot fully discuss today. So that basically means he doesn't really understand. But I will just make 2 brief general points. First, as you know, Japan's economy faces some significant barriers to growth besides deflation, including massive financial problems in the banking and corporate sectors and a large overhang of government debt. Right, this speech was obviously written in 2002. 2002. So reading that now, I don't think many of you guys would disagree that America now has massive financial problems in their banking sector and definitely their corporate sector, and a large overhang of government debt. I mean, if the guy, yeah, I mean, it's just unbelievable. I mean, the guy said it here. America now has all this. Plausibly, private sector financial problems have muted the effects of monetary policies that have been tried in Japan, even as the heavy overhang of government debt has made Japanese policymakers more reluctant to use aggressive fiscal policies. Fortunately, the US economy does not share these problems. Maybe it didn't in 2002, but it probably has greater problems now. It has these problems times 2 at the moment. So fortunately, the US economy does not share these problems, at least not to anything like the same degree. Well, there you go. So even he's even admitting that the US did have the problems even back then, but just not to the same degree. But I would like to suggest that maybe they have it to a greater degree now, suggesting that anti-deflationary monetary and fiscal policies will be more potent than they would have been in Japan. Second, and more important, I mean, this is just about this is. It says more. I'll read. It's not more importantly, but second and more importantly, I believe that when all is said and done, the failure to end deflation in Japan does not necessarily reflect any technical infeasibility of achieving that goal. Rather, it is a byproduct of the long-standing political debate about how best to address Japan's overall economic problems. As the Japanese certainly realised, both restoring banks and corporations to solvency and implementing significant structural change are necessary for Japan's long-run economic health. But in the short run, the comprehensive economic reform will likely impose large costs for many, for example in the form of unemployment or bankruptcy. As a natural result, politicians and economics business people and general public in Japan have sharply disagreed about competing proposals for the reforms. Basically, they're saying that Japan didn't want to go through the pain that it had to do to get out of deflation. Yeah, but I mean, I guess that is important because America clearly is not ready to go through the pain because they just want to do the opposite of this and just print more money. So there you go. So I'll put the link to this to the Federal Reserve speech. This here, it's on the Federal Reserve website. But yeah, so this is basically what we're dealing with right now, guys. And then one of the other key factors you can take from this, Bernanke, obviously this is 2002, we went through 2008, we went through all the helicopter money, the QE, etc., various other QEs, and now we've got gold at $1,530, not $300. So once we get through this next bout of whatever they're gonna throw in the kitchen sink at it, where do you think gold is gonna be in like another 2002 to now is 18 years, isn't it? So where do you think gold's going to be in another 18 years? Probably relatively even higher than the difference that it's made over the past 18 years. But anyway, so I hope that was interesting to you guys. I don't know how many of you guys are interested or financial anoraks, or whether you're just in it for the trading. But yeah, this is the sort of stuff that I do all the time. research and read and learn about things like this because I find it interesting. And yep, so anyway, so remember, this is not financial advice. I'm not a financial advisor. Always do your own research. And so there we have it, Helicopter Ben, the superhero with these bags of cash. Anyway, so thanks for listening, guys, and I'll speak to you guys soon.